Hi, Roberto. Good afternoon and good morning from Tokyo. Thank you very much for doing this call for us in your busy schedule.
Thank you very much. Thank you for having me. Very honored to be here. Thank you.
Let me start by asking you this question. Plug Power is known as a leading maker of hydrogen fuel cells. Can you please explain briefly about your product? What are the benefits of using your products versus the other products that have been in existence?
Sure. So I think when we take a step back and look at our company's beginnings, the company was begun in late 90s and produced this fuel cell product. Our current CEO, Andy Marsh, joined the company in about 2008. Up until then, fuel cells were present and developed by a certain sect of companies, but there really wasn't a addressable market or a use for the fuel cell. And so we quickly learned, and under Andy's guidance, there needed to be a real market that we can target for our fuel cells. And looking at what does the fuel cell provide? What are the benefits? Running on hydrogen, it's obviously zero carbon, but it's a very consistent baseload power. There's very high productivity, low downtime. And so it was a very ideal solution for the material handling business, where we're looking at large warehouses, distribution centers, fulfillment centers, typically 1 million to 1.5 million square feet, operating at 2 to 3 shifts, and typically have 200 to 300 forklifts in them each. And so there's a big premium needed at those sites for high productivity, low downtime. And of course, being a zero carbon solution adds to the solution and the appeal of that as well, of course. But it's a value proposition. When we go into, our primary kind of sweet spot, if you would, within material handling are those warehouses, distribution centers, 50 or more forklifts, where they're operating at 1.5 shifts or more. And so that's an ideal solution to go in, replace the lead acid battery forklifts and or lithium ion battery, really, with our hydrogen fuel cell, put in a hydrogen fueling network in that warehouse distribution center. This provides them a value proposition as they're able to eliminate a very large battery charging room they would need and typically have. These battery sites typically also have 3 batteries per forklift, and there's about 20 minutes downtime per shift. At the end of that shift, those forklifts head over to the battery charging room. There's a couple individuals who man those charging rooms. They take out the heavy lead acid battery, put another one in, and there's also another one that needs to cool while another one charges. And so you're eliminating, obviously, the battery needs in those 3 batteries. You're eliminating the battery charging room, where you can now have more space for goods and services, which are critical in these large supply chains, and also eliminating now the labor that's used for that room on a 24-hour basis can be better deployed elsewhere within that distribution center warehouse. And so our clients have told us, within about a year of changing over from lead acid battery and other sources, they save about $1 million, $900,000 to $1 million by the productivity increases, which is about 15 to 20%. And of course, with our clients and those with the understanding of the value proposition are going directly with our fuel cell solutions from day one. Point of proof being Amazon, who's obviously a very large client, what we deem a pedestal client of ours, is adding 30 or more sites with us this year. That's up from 36, 37 at the end of last year. And all of those sites we're going into are brand new centers they're building. So they're going right directly to our hydrogen fuel cells. And of course, we contract to not only provide them that hydrogen fuel cell for the forklift, we install the hydrogen infrastructure, the filling stations within that warehouse distribution center, and then we guarantee and contract to sell them that liquid hydrogen and provide them that service and guarantee that over the life of that contract, whether it be 5 or 6 years. And that is our core market, material handling. Of course, we're branching out into multiple segments, which I'm sure we'll touch upon in a little bit, but that's been a very healthy business for ours. It's growing at a 40% compounded annual growth rate, and will continue to grow substantially right through 2024 and beyond.
So this your sale business for forklifts in large warehouses. How big is the total addressable market, and what are the future opportunities for you?
Sure. So within just the material handling market, globally, it's a $30 billion total addressable market. In the US here, $10 billion. Of that $10 billion total addressable market in the US, half of that, $5 billion, is directly into our, what I referenced before, our sweet spot, where there are those large distribution centers, warehouses operating with 50 or more forklifts, 1.5 shifts or more, where there's a premium for productivity. That's directly addressable, kind of in our crosshairs. And of course, we're what we would look at the 4th generation of our GenDrives, where we probably have another 4 generations to go in the evolution of our product. And we're working, of course, making it feasible and economic, where it would make sense to go into smaller warehouses, smaller distribution centers as well, where eventually that $10 billion TAM in the US will be directly in our sweet spot and crosshairs as well. And then, of course, you know, within that warehouse distribution center, there are other opportunities for us as well. You know, when we look at going into on-road mobility, each one of these infrastructure sites typically have 2 to 4 filling stations inside. And we've had our clients tell us, well, for us to use a hydrogen fuel cell for our fleet in our trucks, our light commercial vans, our Class 6, Class 8 trucks, what will we have to do to be able to fill up at those warehouses where we already have the fuel cells for forklifts? And all that's required would be putting on another filling station outside, which would be a high pressure filling station, and then also maybe adding additional tanks. But they already have an intact fueling network should they go to hydrogen fuel cells for their on-road needs as well. And then, of course, just like the data center backup opportunities for us, these warehouse and distribution centers are using backup power by diesel generator. And of course, the ability to replace that diesel generator down the line with our hydrogen fuel cell, larger scale type fuel cell stacks, electrolyzers, is also a very good potential for us as well.
To confirm, you sell the fuel cell part of the forklifts, not the entire forklifts.
That's correct. So our forklift application is called our GenDrive Unit. It's a fuel cell design to be a plug and play to every major forklift provider globally. So if our said client has 6 or 7 approved forklifts that they will use in their warehouse distribution centers, our GenDrive unit will fit and seamlessly go into each one of those that they have approved. And then, of course, we'll add hydrogen tanking on that forklift. We add our computer systems, which are very dynamic and operate in real time, providing them with exceptional data and software where they can run real-time efficiency reports that they have told us are better than their own internal software and data. And then, of course, we set up that infrastructure within that warehouse. You know, interestingly enough, when we take out that lead acid battery and transfer over an existing lead acid battery forklift fleet, we actually have to add weight towards the bottom of that forklift of about a couple of 100 pounds to compensate for the difference in how heavy that lead acid battery is that we take out, putting our fuel cell in. You know, we have to add weight to maintain that center of gravity.
And who makes the most popular forklifts in the US?
Yale Heister is certainly among them, but there are a couple of other different forklift OEM providers globally and in the US. Of course, we've been fortunate within, or really, I should say, as a byproduct of our 10 years of $1.6 billion in CapEx and the vast experience we have, the client base we have within the material handling warehouse distribution centers. We've got 40,000 units out there, over 600 million hours of runtime experience. And again, because we supply the hydrogen infrastructure, we supply the liquid hydrogen to all these centers that we're in, we've got over 36 million hydrogen fuelings that have taken place under our watch and under our service supervision in the last 10 years. So we've got a wealth of experience, which has given us the incredibly high market share that we have within the segment.
Can you please discuss the new areas where you could leverage your existing technology? How about the potential in tracking, railroads, shipbuilding, and cargo transporting, perhaps the aviation industry? How big are your potentials and realistic size of the market for Plug Power?
So they're tremendous markets, potential, all of them. And again, depending upon whose numbers you may want to use for what the hydrogen economy may turn to be in 2050, there are numbers ranging from 10 to $12 trillion. There are huge addressable markets within the different segments. On-road mobility is a big focus of ours. We have obviously the joint venture partnership with Renault, which we officially launched just last week with the HYVIA announcement, and that's going to be the name of that joint venture. That's specifically targeting the light commercial vehicle market in Europe, where Renault has a number 2 market share position. We'll look to have test pilot vehicles out by year end. We'll also have test pilot vehicles out in North America and in the US with Linde, BAS Systems, and potentially others by year end. And so we'll have test pilot out vehicles both here in the United States and in Europe by year end into 2022. And we'll look to have fleet production in both areas in 2023. So that's going to be very substantial. And of course, the Renault joint venture is targeting 30% of that light commercial battery electric vehicle market in Europe. So we see that joint venture producing 20,000 vehicles in 2025 and as many as 150,000 vehicles in 2030 in Europe in that light commercial vehicle segment. When we look at large scale electrolyzers and large scale stationary power, that's a huge opportunity for us. That was a primary consideration which drove the partnership with SK in South Korea. As the number 2 conglomerate in South Korea, they have a huge footprint of refineries, chemical, chlor-alkali plants, where a byproduct is gaseous hydrogen. We've already identified with our partners, SK, a very robust funnel where we'll be deploying hundreds of megawatts of electrolyzer on site next to these refineries, chemical plants, capture that gaseous hydrogen, run it through our electrolyzer to produce large scale stationary power. And that's going to provide substantial revenues, which will come on as early as 2022 and 23. But we see that helping to add as much as $500 million to our 2024 revenues.
So what are the obstacles getting into these new markets?
Sure. What we would see, and why we embarked on a very ambitious green hydrogen plant build out. And of course, we're also looking at markets like locomotives, aviation, and also maritime as well. And one other opportunity, which I think I'd be remiss in mentioning, is the replacement of large-scale diesel generators at data center infrastructure sites. We've won one location test pilot with a very large tech company which we'll look to hopefully announce in Q3 whom that is, to deploy multiple megawatts of electrolyzer to replace their diesel generators. And you've had large companies like Microsoft publicly say they'll be replacing diesel generators at all their sites by 2030. And of course, you have large players like Microsoft, Amazon AWS, Alphabet, Apple, with many of these data center infrastructure sites where that's going to be a huge area of growth this year. Something in the terms of about $200 billion being spent in data center infrastructure. Each one of these sites that we go into to replace diesel generator can be as much as a $20 to $30 million revenue opportunity. And just to put that in perspective, the warehouse distribution center we typically go into represents a total of about a $10 million revenue opportunity us between infrastructure, fuel, and service. So these data centers, because of the size and multiple megawatts in capacity that they need, are huge revenue opportunities for us. And again, we're already in a one location test pilot at the moment. We'll have more to announce on that towards year end, but that's an incredible opportunity for us. So we look at, well, what could be the possible obstacle? We knew that as our material handling business continued to grow at a 40% CAGR, it was important for us to be able to source our fuel needs internally. We had to be able to supply all our liquid hydrogen for our material handling clients, to have margin expansion, to have more control over our client base and to serve them better. It also became pretty quickly keen to us for other areas to grow: on-road mobility into hydrogen, data center backup into hydrogen, eventually aviation and maritime, that the fuel to provide for these solutions had to be ubiquitous. It had to be omnipresent. It had to be available. And so that the fuel and infrastructure for such wouldn't be a barrier for these applications to take fruit and to grow. If you look back in 2012, 2011, as Tesla became public, there was always that argument of how can electric vehicles grow if there's not the charging infrastructure there. It's that classic argument of the chicken or the egg. You have to have that infrastructure simultaneously built, if not beforehand, so that these areas and different segments can grow. And so that's not an obstruction or constrainment for the growth to go into these segments. It's a very hard for a large company to give a large fleet order for, say, 10,000 hydrogen fuel cell trucks if they don't believe that liquid hydrogen as a fuel will be there when they take delivery of these trucks. And so we want, and this is such a big market, there's going to be a need for a lot of different players within hydrogen to win, whether it's GM, Hyzon, Nikola. We want these players to win. We want the Ballards to be successful because it's a huge market. And at the end of the day, we're going to have on-road mobility applications ourselves, but we're also going to be there to provide the liquid hydrogen for our customers for these different applications. And we're going to be able to provide it there at price parity with gray hydrogen from day one, with a 30% gross margin to our company. So we wanted to make sure that infrastructure, fuel is being built, is there beforehand, is ubiquitous. And so these areas in the markets, they can grow as the world transitions away from fossil fuels into renewable and clean tech.
Can you please explain the pattern of the order you receive from customers? Do they usually give you a set of, few orders to test and then give you much bigger orders? How does it work?
So within material handling, I think it's important to know, each one of these distribution centers, fulfillment centers, because of the size, again, 1 million to 1.5 million square feet, 200 to 300 forklifts. And the automotive centers that we're going into are even larger. They're larger sites with more automation, so they're using more forklifts. But each one of these distribution fulfillment centers, they can be in a supply chain where they feed out as many as 80 to 100 different sites. So it's a very, very sensitive supply chain. So to your point, we'll typically get an order for 1 or 2 test pilot sites. And there's maybe a 12, maybe 18-month lead time, getting equipment out there, testing on site, setting up infrastructure, transferring over their forklift fleets, and or putting in brand new applications if there's none there that's at the moment. And then after that kind of testing phase and 1 or 2 pilot works out, we're typically to see multiple visibility into their network. Because again, we're working with very, very large clients like Walmart, Amazon, the Home Depot, and a host of others globally like Carrefour in the UK, third largest grocer. And there's so many others, Asda. So as a result, they have a very sensitive supply chain, but they also offer enormous opportunity for us to grow within their own network. And I think a good example of which is Walmart, who last year we announced going into their e-commerce division as well. They have 25 plus sites that are on the same magnitude of their distribution center size in their e-commerce division alone, which almost acts as an additional large pedestal client within a pedestal client. And just so it's clear, we define a pedestal client, obviously one that's large in nature, doing revenues on an annual basis of $30 million or more, where we have visibility into multiple sites in their network. But again, we also provide them that portfolio approach. We provide them the GenDrives, the fueling infrastructure, and then we contract to sell them the liquid hydrogen, the fuel, and as well as provide them that service over that contract. And that's what defines a pedestal client. You know, we're at 4 pedestal clients now. We're working on the potential for a 5th by year end. And of course, we highlighted getting to at least 6 by 2024. But of course, we're not stopping there. And we're very focused on Europe as well, potentially adding a pedestal client there, material handling. And we may have very much have what we would deem as a pedestal client, one that's not necessarily in the material handling segment in a not too distant future.
You know, you're doing a business with someone like Amazon and Walmart. That's a very strong vote of confidence in your products. That definitely is helping your business, yes?
Yes, very much so. And we're very respectful of Walmart, who's joined on with us in 2014, and the confidence that they have with us. Of course, Amazon and Home Depot as well. And I think a big testament is Amazon, who's grown with us at an incredible rate, and Walmart and Home Depot as well. You know, but that they trust us because of the confidence we built up with our reliability. As I mentioned during the pandemic, operating at a 99% uptime, our ability to guarantee service and guarantee fuel is something that in turn creates a very high barrier of entry to potential competition within the material handling market. But as a residual of that, our PEM electrolyzer stack, which was best of breed, the highest power density that's out there at a 4.5 kilowatt a liter, going up higher towards 5. That same PEM electrolyzer fuel cell stack that we use in a material handling warehouse center, it's the same fuel cell stack we use in our on-road mobility, whether it's a 30 kilowatt light commercial vehicle van or a heavy duty vehicle 125 kilowatt solution. Same stack that's used in our 1 megawatt electrolyzer stack. And the point is that fuel cell stack has been used in the field for over 10 years, over 40,000 units out there, operating in the harshest of environments, going from negative 30 degrees Celsius in the freezer area to outside positive 30 degrees Celsius in one drive cycle, operating 24/7, no shock absorbers, and putting more hours of runtime in a year than you'd probably put on the lifetime of your car. And so when we ask what separates us or gives us the confidence that our PEM electrolyzer fuel cell stack will be successful in onward mobility or data center backup, large scale power, we've got over 10 years experience, 600 million hours of runtime in the harshest environment. And so to use that fuel cell stack now in an on-road mobility application is seamless for us. It's a very logical transition.
It seems that your business is centered in the US and Europe. Can you please talk about business opportunities in other parts of the world?
Sure. So when we look at our partnerships, and they're very strategic in nature, and certainly we didn't develop them, in weeks and months. It's multiple months looking for where we wanted to expand geographically, who potentially would be the right partner, where we line up in both our business objectives, business outlook, we line up culturally, and there's the ability to form a joint venture with near and medium term revenue opportunities. And so when we looked over in Europe and wanted to go into that region, certainly, and wanted to go into the on-road mobility market there, Renault, where we already have offices in France, and we began talking to the companies many, many months ago. Number 2 market share position in the light commercial vehicle market. Seemed like a very logical partner for us to be talking to. And then, of course, we also think about other markets, tertiary, that we would want to go into with that partner. And Japan, of course, being one of them. With Nissan 44% being owned by Renault Group, that's going to be very helpful for us as well. And then when we look at in Asia, which was a big area of focus for us, we didn't want to be in a position where we necessarily wanted to give up our intellectual property, our technology. We didn't just want to provide our fuel cells, our stack, our electrolyzer, in the same way that with the HYVIA joint venture with Renault, we'll be making and designing, producing that vehicle with Plug Power. So we're producing that vehicle in that joint venture, not simply selling our fuel cell stack. The same way in Asia, and looking in very favorable areas to do business within hydrogen, South Korea being high among them. SK lined up very well with us on multiple fronts. And again, they have this huge network of refineries and chemical plants in South Korea. We will put large-scale electrolyzer on site with them, capture that gaseous hydrogen to produce large-scale stationary power. We'll also look, of course, to produce hydrogen there as well and go into on-road mobility, filling stations and fuel infrastructure as well. But there's a huge near-term opportunity for us there with electrolyzer. And of course, China and Vietnam are markets where we're very keen to enter as well. And SK's relationships there are top tier, and they'll be very helpful for us in those markets as well. Other areas, of course, we're focused on India, Australia, and of course, there's a lot of room to expand in multiple fronts here in the United States, both within material handling, on-road mobility, large-scale data center backup opportunities, and others. So geographically, I think we have a real competitive advantage where we've got some of the strongest global partners out there. We'll continue to develop and form meaningful partnerships when it makes sense to. But I think that when you look over at what would be our competitor 12 months or 18 months ago, there really isn't a direct competitor comparison you can make, because we're truly a globally, fully vertically integrated hydrogen solutions company. There are no players that can really make that statement. There are some very good electrolyzer players, companies. There are fuel cell provider companies, fuel cell stack provider companies. There are energy companies that produce gray hydrogen, or industrial gas players that produce gray and blue hydrogen. But in the middle of all those items and the different applications from on-road and others, we're in the middle of that and producing liquid green hydrogen on our way to producing the largest global network that's going to be green and the largest network in the United States for liquid hydrogen by the end of 2023, where no one really can make those statements. You have the experience we do with liquid hydrogen. You have the experience that we do using our PEM electrolyzer fuel cell stacks in the field, handling liquid hydrogen, delivering it, servicing it, the experience we have, and then building these plants that we're building for green hydrogen in the United States and then globally. You know, will really set us apart as truly a leading hydrogen solutions company.
How is the recent ESG awareness across the entire spectrum of corporate America is changing the outlook for your business?
So I think, again, it's an important distinction. Just like material handling, we look for all our applications to be value proposition without subsidy, without tax credits. You know, there was a time where investment tax credit in the United States lapsed and our business didn't skip a beat because there's a value proposition there. And while at current, there certainly is a price premium that's paid for a hydrogen fuel cell for onward mobility or large scale power, we're working very dramatically to come down the cost curve. In the same way that every time we've doubled the amount of GenDrive for forklifts that we have out there in the field, we went from 5,000 to 10, 10 to 20, 20 to 40. We dropped our costs by about 25% with those GenDrives, simply by the scale, the experience, the knowledge, and intelligence that we acquired by doing so on that type of scale. With the amount of electrolyzer we'll be building both for internal consumption for our hydrogen plants, but also for our partners and clients like SK, by 2023, 24, we'll be producing more electrolyzers than anyone out there. And that experience, the ability to have a gigafactory that's going to be fully operational in New York in this fall, in Rochester, New York, that gigafactory on an annual basis will be able to produce 500 megawatts of electrolyzers, 60,000 fuel cell stacks. And we're already thinking about a gigafactory in France with the Renault partnership, in South Korea with SK, and then potentially a second one in the United States and North America as well. So that will allow us to come down the cost curve with electrolyzer by as much as 70% in the next 3 to 4 years. And so our end goal is, and I know it's a little different slant to the question you've asked, but we want to be a value proposition to all applications that are traditional now. And so we want our fuel cell for on-road, we want our electrolyzer, we want our hydrogen fuel to be in price parity with diesel. And that's the end goal. The ESG sustainability push has been just an added tailwind for us. And of course, there are numerous items that are potentially being proposed in Congress in the United States. There are many very good country push and subsidies globally, as mentioned specifically in South Korea. And there's very ambitious goals with hydrogen in many countries in the European Union. So it's certainly been a boost for us. It's been a tailwind. We don't model or depend upon it, but certainly if some of these items do come to fruition, specifically here in the United States, it certainly would fast jump and increase adoption and be an additional tailwind for us. And again, I think it's important to go back and make the distinction. These are solutions our clients want. This is corporate driven. This is by our clients, whether it's Amazon, Walmart, leaders globally like Microsoft. And there's this push that's truly away from fossil fuels. And if you don't believe that, one only has to listen to the last call transcript for either Royal Dutch Shell, Exxon, Chevron. When you have the super majors all talking about exiting oil and gas, using those revenues to fund their energy transition, and all of which who mentioned hydrogen, you can believe that this is something it's not a matter of if, it's a matter of when.
Okay, on the competition, can you please discuss your competitive landscape? Who are the top 3 competitors?
You know, that's a difficult question today. If you would have asked last year, early last year, mid 2020, you know, you could probably say Ballard Power because of their fuel cell stack, which is a very good fuel cell stack that we actually used to buy before we started formulating and making our own. You know, there are electrolyzer players out there like Siemens, Nel, other fuel cell providers like PowerCell. But when I look at our company, again, if I think about all the different hydrogen applications and segments in a matrix, Plug Power is right dead center as one who touches all of those segments, whether it's on-road mobility, material handling, production of liquid hydrogen, and we're all looking to do it as 100% green, renewable hydrogen. We look at electrolyzers, and we look at our global footprint now. There really isn't anyone who can make the statement where they touch all those items. They do it on a global basis. They're vertically integrated, and they certainly have the ability to move as quickly as we do. And we have the ability to certainly, with a robust balance sheet of about $5 billion in cash and cash equivalents, we can move very quickly and very strongly into different markets to really grow market share. And what we see is really a $10 trillion hydrogen economy by 2050. And so we've embarked on this very aggressive hydrogen build-out strategy, but that same methodology of growing strategically market share into these new markets is something that we use across the board, whether it's electrolyzers, material handling, on-road mobility, etc.
Why do you focus on gross billing as opposed to gross sales?
That's a good question. And I think sometime down the line, in the not too distant future, we'll continue to move away from using gross billings. But, you know, when we began the material handling business, we were looking to grow it and grow it feverishly, intensely. Signing up Walmart was obviously a tremendous win for us in 2014. When Amazon signed as a client in 2017, as they do with other growth vendors that are publicly traded, they comprise these vendor market warrant deals where they know that when we sign a contract with Amazon, we're certainly going to have a pretty healthy press release to let the world know that we signed on Amazon. But Amazon doesn't necessarily want to have reduced ASPs when they buy scale. They want to grow and align their interests with us as their supplier. And so they set up, and we set up with them, a revenue tranche system where they would earn warrants in our company as they reach certain revenue milestones. Because of that, as these milestones are met, and then we look back and thought, Walmart, certainly our first pedestal client, should have the same deal as Amazon. Walmart certainly felt so, and we agreed. And so Walmart and Amazon had these two warrant structure deals that were incentivized. And so as they continue to grow and do business with us, the warrant, like a compensation charge, it's a non-cash charge on our balance sheet. The more and more business and revenues that Walmart and Amazon were doing with us, the larger the charges we're getting on a quarterly basis. And of course, the formula that gives these non-cash charge expenses and what they may be is a Black-Scholes model, which stock prices are variable. So the higher our stock price did, because the busier and more business we were doing on a revenue basis, the higher that charge was. And so gross billings is essentially our gross revenue number before those non-cash warrant expense charges are backed out. And further to that point, because of the visibility we saw with Amazon this year and next, again, they're adding over 30 sites with us this year alone, almost doubling the amount of sites and install fleet they have with us. They would have reached that final milestone likely within 12 to 18 months. And there was this widening spread because they were doing more and more revenue with us. There was continually larger non-cash charges every quarter. The spread between gross billings and then backing out that warrant expense was continuing to widen. So we made the strategic decision to accelerate Amazon warrants on what they left at the end of last year, which of course resulted in a very large non-cash charge. But going forward now, we only have the Walmart non-cash warrant charge expense. And so that warrant charge expense winds up being about $1.5 million to $2 million a quarter. And so on an annual basis, it's about $8 million. And so that difference now between gross billings and revenue will be much smaller than what it was prior.
Interesting. How big are their positions when they exercise their warrants into stock? Are they going to be a significant shareholders at this juncture?
The potential is, I mean, theoretically, Amazon has earned the balance of their warrants. So they have excess of 55 million warrants in the company. They expire in 2027. So if Amazon exercised all the warrants and held the stock, would they be a significant holder? Yes. They'd be somewhere between a 9 to 10% holder. Walmart the same way. Now, I'm not sure that that's their strategy to do so. I think as our stock continues to move higher, again, Amazon has these warrant deals with multiple companies that they do business with. So do they hold these warrants and then exercise and hold that stock? It's probably a better question for Amazon or Walmart. But we surely saw this type of warrant agreement as aligning our interests with the client, and certainly was beneficial for both our parties.
Can you please update us with the current state of the accounting issue?
Sure. So the current status is there is no longer any issue, thankfully. We restated our 10K under the advice of our auditors, KPMG, who again, we've had KPMG as an independent auditor for over 25 years. And as they rotate different partners on our account, looking back at the sale leaseback agreements that we conduct, and again, in our material handling business, just like you were to buy a car, you can either buy a car direct and or finance, or you would lease it, right? So our material handling clients pay by the same way, 60% or so by direct purchase, the other 40% by leasing the equipment and infrastructure with a bank in the middle. Accounting rules came onto the books in 2018, which said lease accounting now has to be put on the balance sheet. Under the advice of KPMG at the time, we did so. We modeled accordingly. KPMG agreed. Come 2021, there was a desire to look back now because we have so many more units out there look at these sale leaseback arrangements and running different simulations, should some of those numbers on the balance sheet be different? And there was the decision that some of them should be different, but again, which resulted in non-cash charges, had to do with the value of that asset from the onset. Is that the right value that it should start at versus that obligation, which at the end of the day and the end of the contract both go down to zero? Should it be a different level? Should the residual value of the GenDrives after the 5 to 6 year contract that we buy back, should that residual value be something different? So all these were taken into consideration, and there was modifications done. Again, though, we are the precedent in this market. We started this market for fuel cells. There isn't someone else to look at as a precedent to model after. It's a nation business that we've started. And so now with the benefit of hindsight, looking back, 40,000 units now out there, another 10,000 units just last year that we deployed in 2020. Could the modeling be a little bit different? And it was decided with KPMG that it should be. But thankfully, those restatements are behind us. We're, of course, using KPMG's modeling and opinion and advice going forward. And we'll look to have our Q1 earnings out shortly, but those are behind us, that 10K restatement.
And you are to announce your Q1 earnings on June 14th, next week?
We're likely releasing Q1 earnings during the week of the 14th, correct?
To confirm, how much is a unit of your cell?
The GenDrive unit?
Yes.
What is that?
GenDrive, yes.
So we have 3 different GenDrive classes, class 1, 2, and 3. And there's a range in prices. And then, of course, there's warranty on top of that, which all clients opt for. But the short answer to your question is the average selling price ranges about $15,000 to $20,000 all in with warranty.
And how much was it a year ago?
Probably between 20 to 25. As I mentioned, we've been very thoughtful. We've been very intelligent. And as we continue to double our install fleets that are out there, we've come down the cost curve dramatically.
And also you're making a productivity improvement as well.
Productivity improvements, we've come down the cost curve. So the reality is, while we do model in some ASP degradation, quite frankly, we haven't seen that. Even when we renew our contracts and we replace the GenDrives every 5 to 6 years in each of the sites, we're signing on contracts at very similar ASP prices. And so we've been very fortunate. We haven't really seen any ASP degradation today.
So this is going to be my final question for you. Will Plug Power achieve positive EPS by 2024? If not, by when?
So the answer to 2024, no. But we do think we'll receive positive EPS by the end of 2022, next year. So we're looking forward to that, and quite frankly, we would have achieved that sooner. But again, with the markets growing the way they are, we're spending a large amount of CapEx this year. We want to have large market share in all these markets that we're going into. And so, we're spending CapEx smartly. We're spending OpEx smartly. And we'll continue to do so to solidify our market share in these huge markets going forward. But we'll look forward to having positive EPS by the end of 2022.
Well, Robert, thank you so much for doing this call for us and for your existing and potential individual investors in Japan.
Thank you so much, Hutch. Well, thank you.
Like
I appreciate this opportunity and very exciting.
Sounds like you're going to have a very busy years to come.
Yes, very much so. It's going to be a very busy but a great year for us. And I think when we fast forward to 6 months from now, you're going to realize that Plug Power not only separated itself from what were the peers, but we happen to be very, very good chess players. And a lot of the pieces we put on the board last year, earlier this year, you're going to really see them come to some real concrete visibility into revenues, which is going to be really exciting for us.
So I wish you a great years for Plug Power, and
Thank you
hope to meet you again soon.
very much. Thank you so much. ありがとうございます。
ありがとうございます, and have a great weekend. Bye-bye.
またね。